trend following algorithms to crypto works like a motherfucker. So let me show you what we're doing here. You can see my screen, right?
Yeah.
So if we take, let's take, say, Ethereum.
What platform is this that you're on?
Oh, this is just a custom thing, right? This is all our own dashboards. It's not someone else's platform. We built it right from the start. So,
oh, nice.
Oh, that's Ethereum Classic. Fuck that shit. Let's look at Ethereum. So, trend following is. Excuse me if I'm like. I'm sure you know this. Trend following is the idea that you buy what starts going up and you short what's going down.
Yep.
And
Yep.
if you average those out in the long term, there's a profit in it. But the problem is that the win rate is very low because you're trading for outlier wins. So typically a win rate is around 40%, which means people hate it. Because people hate doing it,
right.
The risk is fundamentally mispriced because it's a shitty thing to do in real life unless you've got it completely automated. So the risk is fundamentally priced and there's a consistent and strong edge. So what we do here is we have 36 different trend following algos, which are pretty standard things. You know, these are different moving average crossovers, different Bollinger Bands, different breakout periods, I'll run through this in a minute, but different breakout periods. This is something we stole off a hedge fund called Fidelity. This is normalized momentum from a hedge fund trader from NHL, MACD. And what we do is we combine all of these forecasts. So if we look at, say, all of these forecasts are little dots, they get averaged into a combined forecast. If the forecast is positive, we go long. If the forecast is negative, we go short. It's pretty simple. Now, what we do is volatility. I mean, you're a volatility professional, so you know that volatility has two inherent properties. The first property is that in the short term it's likely to be stationary, and in the long term it's likely to mean revert, right? So the biggest predictor of tomorrow's volatility is today's volatility. You can predict that, you know, with 95% accuracy, tomorrow's volatility is going to be today's volatility. So what we can do is we can set a volatility target, like how much vol do we want our Ethereum position to add to our portfolio, and then multiply that by our volatility estimate forecast for tomorrow, and we can get a position size down here. And so every day we wake up and go, what position size do we have tomorrow? What position size do we want? We want slightly more. We go into the market and we buy a little bit more. We want to add to our position, add. And let me just back this off. So it's been the last 2 years. So let's look at, you know, from the market top. This is the top. You can see as the forecast goes down and as volatility goes up, we're ratcheting off our position. Trend following paints lots of small losers and then very big wins. So it gets short right here, short, starts aggressively banking positions, gets out, and let's look at Bitcoin because it's one I'm more familiar with. So 5 years. So anytime you get a really big outlier move, like a fuck off, Bitcoin goes from 10,000 up to 60,000.
Yeah.
It's going to catch the whole move. So aggressively take on position. And you can see as volatility spiked, even though our forecast was still high, because volatility spiked, the ideal position size is smaller. So it's banking profits, keeps you in all the way till here. And what we find is that if you're a good discretionary trader, getting in here and getting out there, that's like fucking well done, bro. Right?
Yeah.
Like that's as good as me. That's as good as me on my best day, looking back as like that's the best trade I've ever taken. So
Right.
So the problem with trend is because the win rate is low and you're relying on outlier wins. If you've got a 40% win rate, and of those winners, about a third are going to be small winners, about a third are going to be medium winners, and only about a third of 40% are going to be big winners. And of those, only a small number are going to be out. So you're waiting for a lucky win. If you're relying on luck, you might need to wait a long time. So how do we deal with that? We trade every fucking coin that we possibly can. Now, if you were to do this in the traditional finance futures market, which I've done for many years, you need to have CME margin for every contract that you trade. And some of those margins are expensive. Bitcoin is 30 grand US in margin. Crude oil is 7 grand. You know, it adds up super quick. You can't afford to play the game, but these cryptos are designed for degenerates. You can have positions, you can trade 100 coins simultaneously with a $1,000 account. Now, let me show you what this looks like. Oh, I'll find it. Here we go. So, actually, that's since 2018. Let me just find one sec. Let me find something a bit easier to see. So this is Bitcoin, right? The yellow line. The big problem with crypto as a market to sell is that it's basically a kind of a market. You make a shitload of money, and then, oh, look, the next year you get fucked and then you lose most of it. And then you make a shitload of money just when it looks like it's going to be great. You lose half of it. It looks like it's going to be okay. You lose half of it again. It breaks your fucking heart. And you lose another half. And then it's just a kind of a thing, right? Like it's obvious that there's more. It's obvious that there's more risk and therefore more return. Like all the things you do, like the volatility rate premium, work much better in crypto than they do in like everything that what we've branded as the big discovery in little guy finance is that all this stuff from our world, when you apply it to crypto, works much better. So if we look at the volatility rate premium, I mean, you're looking on average, if you're selling S&P index vol, you're looking at what, a 4% of edge, 4 vol of edge. That's pretty good. You know, in crypto, you're looking at 20 vol of edge right now in ETH. You know, so the edges are like 5 times as big. And so what we find with when we apply standard trend following algos, and trend kind of sucks because it goes sideways, makes a lot of money quickly, goes sideways, makes a lot of money quickly, goes sideways, so you can tell it's waiting for a lucky win. It gets a lucky win, goes back to going sideways. But what this does is if we look at it year by year, the yellow is Bitcoin, the blue is our system. 2019, both did great. Our system did a little well. 2020, the best year ever. Bitcoin did 300%. We did 150. 2021 had a crappy year for Bitcoin. We did great, over 200%. 2022, Bitcoin lost money. We made money. We're up for the year now. This is an old document. So we've turned this from make money 1 year every 5 years, then go get fucked, to make money every year. If we think about if we think about what we need for a direct response product, what do you need it to do? Nothing to learn. It needs to do. No one wants a new fucking job understanding volatility. Like no one's after a new job. You don't have to know anything. You don't have to do anything. So what you do, it's a 3-minute setup. You put your API key, connect to your crypto account, your Binance, your Bybit, your KuCoin, your whatever, and we're expanding it out to distributed exchanges. It trades 100 coins automatically. It does it all for you. And if we look at the drawdowns, I'll explain how the system works in a sec, but the drawdowns get better and better. And we've got an average drawdown of 8.3%. And if we look at, you can customize it for your own volatility targets. So if you're a conservative investor, you can dial it down or dial it up. At Kelly, we've got a compound annual growth rate of 107%. We've got a Sharpe ratio of 1.81. This is all after costs and after reasonable assumptions for slippage. So no bullshit in the back test. And we've been running this live for over a year now, and our numbers in production have been roughly what the back test is. Sometimes better, sometimes worse. The catch with trend is you get long, severe sideways drawdowns that can test the patience of investors, which is So it's the opposite of selling volatility premium, selling options. You make money almost every day, and then you wake up a couple of times a year and you've lost 25% of your account, right? Like that's how it goes.
Right.
This is like the evil twin of that. So most of the time, most of the year you do fucking nothing, and then 3 months, 3 separate times a year you just print it and then go back to going sideways and then print it. This is what it's
Well,
like.
that's the challenge, that sideways period. If you look at that chart you're looking at right now, from July of
Yeah,
2020.
this would test anyone. It's back at high.
Dude, man, you know how people are. If they start at the beginning of that, they'll tell you to fuck off.
But we've got a plan to deal with this. So this is a positive skew edge. We plan to add negative skew edges in, like carry is the obvious one. So the idea is that we blend something that looks like the return curve of what you guys do, and then we've got something smooth in it. But we wanted to start with trend. Why did we start with trend? Because trend is the lowest degree of difficulty. It's the hardest to fuck up. It's like a horror movie that works out in the end. And because well, it is. That's what that's like I've done it for so long. It's just like, this people say, trend is the best edge, and it's not actually a good edge, because the good edges all get arbitraged away inside 2 years. The edges that stick around for 100 years are the things that are objectively mediocre edges, like selling puts, like trend, like value, like carry. The stuff that's like, it's okay.
Yeah.
But what we found is that everything that you take from the real world that actually works, apply it to crypto, and it works great, like a lot better. And so it takes these mediocre edges and turns them into something you can really live with. Now, let me show you how it works. So,
are you trading daily charts?
It's daily charts, and the reason for that is your costs are highly predictable and your returns are highly unpredictable. So, a slow trend following system will turn over your account about 7.6 times a year. A fast trend following system will turn it over about 54 times in a year, and the average is about 14 times a year. So that's considering both the fees and the slippage are higher in crypto than they are in traditional finance. You have to be really, really careful about costs. So we did all our modeling and things after costs. So for example, today, so we take a forecast with a maximum of 20. The reason why we cap it, which is pretty standard in the hedge fund world, is because a strong trend is prone to reverse, like bear markets end in despair, bull markets end in euphoria, right? So these are the things that we're long at the moment, and these are the things that we're short. So we're long the strongest coins and short the weakest coins. And what we do is, not all of our signals perform equally as well. So for example, our moving average crossover signal here on Bitcoin is performing much better. So it gets more weight. So this has 44% of the total weight, whereas breakout, which is this one, has 29% of the weight, and the rest are fuck all. Now, if we look at an individual thing like breakouts, after costs, a long-term breakout tends to perform better because it's turning over less. So this would logically get more weight. So the longer-term breakout 160 and breakout 40 is getting 25%, breakout 160 is getting 21. And this is standard, quant firm architecture, rebalancing. This happens once a week, and we do this with all our various signals on all our various coins. And the net effect of that is, this is what it looks like when we're equally weighted. You can see the drawdowns are a little bit higher. After we do the fitting process, which is that, the drawdowns are much more constrained and manageable because it's allocating less weight to an instrument that's underperforming. Do we use a rolling window? No, we use the total amount of data that we have. So if one of our signals was to stop working, then over time it would be gradually down weighted until it was insignificant. So it's a pretty neat thing. It's got
hey, Scott, this is your custom software right here.
Yeah, this is what we built.
So does the user see this, or do they just give you their API and not have to look at this?
They don't have to look at this, but they've got another thing which is like a simplified portfolio management system thing.
So this software here, do you is this what is actually triggering the API stuff?
It's all running in the cloud, but no, this is a front end stats package called Grafana, which plugs onto anything. So this is just a dashboard plugging into our ship.
I see. Okay.
So
what I'm just curious as to the technology that you're using to actually run your algorithm. What is that?
We built it custom from the ground up. It's all running on our Amazon Web Service at the closest co-location point to various exchanges. So when we run an exchange, we figure out what's the closest AWS to that exchange. The whole point of doing risk premium harvesting strategies like Vol, like Trend, like Carry is that they're generally high capacity and generally lower turnover and lower cost. So you don't have to be as careful, but we're still very, very careful about cost, just because that's like the pro way to go, right?
Yeah. Awesome.
Yeah. So
what's the minimum account size?
$2,500 is probably below.
That's it?
But below that, you can still trade it with less. But what you run into is minimum transaction costs on crypto futures.
Yeah, that was my concern, because those transaction costs will eat that account up if it's.
But crypto transaction costs